I've listened to both Dan and you regarding my current situation. I'm 64 next month. Plan to work hopefully another 3 years. I'm in the 55 to 65 model, but I'm probably about 39% cash. Let's call it 40% cash. Listening to you, I'm moving it to TPHE because apparently that's a little bit better than TPHD. But I have a fairly large amount in TPHD. Do I take that in kind and move that into HE, or do I leave it as is and all future monthly purchases go to HE?
Okay, great question. So what I would suggest now, you can't do an in-kind or an exchange on ETFs because ETFs trade like stocks. So you have to actually, you've heard me talk about doing an exchange when you're going from mutual funds in the same fund family. But with ETFs, you actually have to sell. So what I've recommended is that we did increase the allocation there to that particular ETF. And if you already had the original one, not the HD, not the HE, is you can keep a 50-50 strategy going there. So maybe sell half of it and move half of it into the HE strategy. I would continue to put any new money into the HE. Now, an ETF has a predetermined strategy. So it has a set of rules that it is managed by. And this particular one has a focus on income. So it looks at all of the companies in a particular index, filters them down, first of all, to be biblically responsible, then based on size of the company. So it's going to take the largest. Size being large is an indicator of safety. It's not a guarantee that things won't go down or anything like that, but it's an indicator of safety. And then it filters them down. They have to have 4 quarters of positive earnings, which is a little bit more challenging to do going forward, I think. Then it is going to narrow it down even more. They have to be U.S.-based companies, obviously. Then it's going to narrow it down even more to the top 100 highest dividend-paying companies. So dividends and dividend growth is also an indicator of strength for a company. Now, what the enhanced strategy does, it says it follows an index and it looks at that index. When the index is down 8%, it has the ability to shift to 75% cash. So if you were to do this in your portfolio, and let's say it was a taxable portfolio, you could be subject to capital gains if you have gains in the positions that you're selling out of. Since it's in an ETF, it has a little bit better tax treatment. They do not have to pass along the gains. So they can shift to a 75% cash position and cause you no extra taxes or no tax headaches. Then it's not just a preservation kind of strategy when the markets go down. It looks at redeploying that capital at certain strategic points. So once it goes down more, then it starts to redeploy some of that cash, trying to implement the strategy of actually selling high and buying low. So that is what you should do if you're in that 55 and up category. I prefer the enhanced version. It's the same holdings. It's just that the enhanced strategy has the capability to go to cash and then redeploy that cash.